Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. Great to have your company this Thursday afternoon. I'm Juliette Sarli. Let's have a look at where the local market is finishing the day's trade. It is a negative session coming through here. We've seen gold fall below $4,000 an ounce. CommBank's Vivek Dar saying this is really testing the durability of the recent safe haven narrative. And resource stocks really have dragged the overall market lower because we've also had oil extend its declines and investors digesting this stronger than expected jobs data that we have seen as well. So overall, a little bit of a negative session coming through for the local market. The S&P ASX 200 down 49 points or 0.6% to 8,759 points. All right, let's get into the themes of the day, given all of that. And it's men at work. We actually saw a drop there in some of the female jobs in the latest labour data. A lot of this, of course, is seasonal. Let's bring up the themes so people can see what they are. And we did have the jobless rate there dipping back to 4.4 from 4.5% as expected. The participation rate edging up to 66.7%. So the jobs market showing somewhat signs of resilience here. More than 40,000 jobs created in May, above expectations. But, you know, we had the inflation print coming through yesterday as well. So financial markets only pricing in about a 23% chance that the cash rate will rise to 4.6% at the next meeting. Well, pre-war levels, this is all about the Middle East war, is where we're seeing oil giving back all of those gains that we saw during the uncertainty of what has happened in the Middle East. And then, of course, putting all of that together, the ASX has dropped today, or somewhat of a Thursday tumble, if you will. All right, let's have a look at some of the sectors then, or just in fact get in straight to the corporate stories. And Judo Bank there is falling, biggest one-day fall on record following a profit downgrade due to this deterioration in asset quality, which lifted provisioning charges. Worley also under pressure, saying the impact of the Middle East conflict and the stronger Aussie dollar hurt expected earnings for 2026. And MinRes under pressure after announcing that its Lucky Bay Garnet project in WA will be placed into care and maintenance from the 1st of July. A2 Milk, though, heading the right way. It declared a special $300 million dividend after securing a key Chinese regulatory approval tied to its Pekenko infant formula facility. Echo IQ, that was the stock of the day on the call. You'll have to wait there to see what the panel thought about it, but it did rise quite substantially after securing an agreement with Pro Medicus that includes a strategic investment of up to $20 million in a commercial partnership in the US. Tourism Holdings there surging. It revealed it had received a new takeover proposal. And Credit Clear plunging to a record low. The ACCC saying 2 units set more than 320,000 debt enforcement notices, which were misleading and in breach of the Australian consumer law. Let's get an outlook then on how he's seen the market action and everything that we're monitoring. And welcome to the COB, Clifford Bennett from Propex24.
Thank you very much, Juliette.
Good to see you, Clifford.
Good to be here.
Well, let's just talk about the wild moves in oil and now back to levels before the Middle East conflict started in February.
Yes, almost back there. I mean, we bought oil at 65, sold at 100, which was one of the best trades of our careers for our clients. But I think 65 is about where we should be going. And it's reasonable to expect some sort of overshoot to the downside after the market having been so speculatively long, as well as justifiably fundamentally long. It's great to see peace happening across the Middle East. We hope that'll take hold in Lebanon as well. And everything will stabilize, and wouldn't that be wonderful? And it certainly looks like that's going to be the case. So there's no safe haven there at the moment in terms of oil or gold, as you mentioned in your introduction, because things are coming down. We still have a war in Europe, though, a significant war, and that's something to keep an eye on and not ignore. I think with the oil price, we could see an overshoot towards $60, but then I wouldn't be surprised if the market was surprised and we had a rally back to $80 a barrel, because it's going to be the case going forward that there still is shortages of supply out of the Middle East. A lot of experts are saying it could be 6-9 months, some think 12. but let's say it's in the 6 to 9 month range before oil supply out of the Middle East has returned to normal. I think the world is down sort of 9 to 11% on supply at the moment, but that's still a significant loss. And therefore, oil retreating to where it was before the war isn't quite right, and is that overshoot I was talking about. The other big factor to consider for oil traders going forward over the next 12 to 18 months is that basically every country around the world's breathing a sigh of relief on energy supply, but they will also recognize that they do need, in this slightly turbulent world we now live in, to certainly maintain their strategic reserves, if not build even greater strategic reserves. And in the United States, their strategic reserves had fallen about 40%, which didn't get a lot of headlines at the time, and also might have been part of the reason for an end to the war, for a peace deal. But that's a lot of rebuilding to be done as well. So all around the world, pretty much every country, I mean, Australia may even think, oh, heaven forbid, Australia might think about having its own oil reserves on our own continent. Wouldn't that be amazing? What forethought? So what I'm saying is sovereign demand for oil will be very strong over the next 12 months. Oil supply will be less than it was before the war. So doing that math, it's back of the envelope. I think an overshoot to the downside, then a strong recovery in oil is a likely scenario.
All right, well, a lot to unpack there, and of course a lot feeding through into inflation too, because it's still going to take a long time for us to get situation normal with the ships through the Strait of Hormuz. We had the jobs data coming through as well. Cliff, I know what you think the RBA should do, but what do you think we are going to actually see, given everything we've had with the inflation print yesterday, the job data today?
I think with the inflation print, with oil prices falling back quicker than most people thought they would fall back, President Trump got something right. It's probably more a lucky thing than a well thought out thing. But oil falling back faster than people thought, the inflation print being modest, still quite severe. It's nearly double what it was a year ago, but consolidating at least over the last couple of months, pulling back a little bit. And with that jobs data today, I think there's no reason for the RBA to hike interest rates again. I mean, I saw at most one more hike, and I thought that was an if, with an equal balance of scenarios for no more hikes, then rate cuts. So I think people need to factor in that the next move by the Reserve Bank could well be to reduce rates because of a weakening private sector, with inflation not seen to be the great uncertainty and great risk that it was. Of course, I never thought that was a reason to be raising rates anyway, but the RBA did. But just from the RBA point of view, as you've asked, they would now be seeing that the oil price uncertainty is diminishing quickly. That could even be deflationary, in 6 to 9 months' time. And we've got unemployment too high, but not at a drastic level. And we have a private sector that has been slowing somewhat. We only had a 0.3% GDP print for the first quarter. So I think there's plenty of reason there now for the RBA not to hike rates again at all this year, or even next year. And in fact, the next move could be a rate cut. I would say the rate cut move is probably 3 meetings away.
Yeah, it certainly seems like we're at least going to be holding here for some time if they don't indeed hike. You touched there on President Trump getting something right. We've also had, since I think that you and I last spoke, the new Fed chair, Kevin Warsh, speaking as well. I thought he was taking a bit of a leaf out of Michelle Bullock's book there by getting away with forward guidance. What do you think about what we saw last week from the FOMC?
Well, the forward guidance was really, the dot plot is really a Fed creation, and they're removing it, and removing some of that guidance is a good idea, because it was a little bit embarrassing for the Federal Reserve that people like myself could forecast Federal Reserve monetary policy better than the Federal Reserve could. So basically, to avoid that embarrassment, and also I really think that's a big part of it. I think Kevin Warsh is a good selection for the job. He's going to be more of a modern and more of a globalist, I think, Federal Reserve chairman. But I think it's a good idea to remove that. And I think a big factor of that was its poor performance anyway in being a reliable indication of what the Federal Reserve would be doing going forward, because circumstances would change. They wouldn't understand the economy and certain impacts in real time, and so their dot plot and their own forward suggestions were often quite wrong and embarrassing. I think it's only a first stage. I think we're going to see more of a Federal Reserve re-energized to actually get it right and focus on getting it right, and less on the political game of how they're seen in the public domain. And I think that refocusing of energy for any central bank, which would be nice for the Reserve Bank of Australia to do, is a good thing. So I think that is a positive for the US economy moving forward.
All right, Cliff, always a pleasure to chat. Thank you so much for your time.
Thank you very much, Julia.
Clifford Bennett there from Propex24. Well, we talked about the stock of the day being Echo IQ. I spoke to David Bird from Mastering the Markets, his first time on the call, and Howard Coleman from Team Invest.
Been listed for 10 odd years. It never makes any money. It runs at a loss every year. The losses get bigger every year than the year before. So from a point of view of looking at it as a company, it's not a business really. It's an idea so far that will hopefully make money somewhere down the track. But the big change, of course, is Pro Medicus having put some money into it, and Pro Medicus having the marketing clout to actually market it.
The strategic investment from Mercatus is obviously a major positive, and it validates the EIQ technology. It kind of turns a little bit more from a story to a little bit something more. The potential for Pro Medicus to become a reseller will give an EIQ that access to the large hospital network, etc., is obviously a good thing. The existing products continue to see strong growth in customer usage. And the big catalyst would be the FDA decision that would be likely around that might link it a little bit more. But I'd have to agree with Howard here. To me, that gap up is a little bit worrying because it's gapped up and it's then stayed stagnant.
Let's have a look at some of the market leaders in a down day. Lendlease had a good session, as did Reece as it came out of a trading halt. James Hardie was up 5.4%. Little love at the moment for some of these healthcare stocks. So ResMed did well, and a little bit of love for some of the consumer discretionary too. Lovisa up 5%. The laggards, though, of course, Judo Bank there having its biggest one-day fall, on record, slashing its company profit guidance down by almost 40%. Worley also came under pressure after it came through with a trading update down by about 10% to $11.09. The small cap leaders and laggards, Tourism Holdings, well, it had an update as well, sending shares up by some 13%, while the laggards in the small end of town included Credit Clear. We just talked there on the reasons behind that 21% fall. Well, tonight we have US quarterly GDP, also Telix coming through with its quarterly earnings on the NASDAQ. And then tomorrow we've got the NAB quarterly business confidence survey to round out the trading week. Final check on where the local market has finished the day's trade, and we are weaker by 0.7% there on the S&P ASX 200. The CBO 200, the S&P ASX 200 down 60.7%, 8,748, so crossing below its 200-day moving average. All right, it's been quite a big week. We'll do it all again for the final trading day of the week here in Australia tomorrow from 9:45 a.m. Eastern. We'll see you then.